Good evening, everyone, and thank you for joining us. We will begin shortly. Hello, everyone, and thank you for joining us tonight. My name is Lisa Jacobs, and I'm from the Marketing Department with Ardent Credit Union. We've had several virtual workshops over the past 6 months, but sometimes technology is not always our friend, so please be patient with us. There's a lot going on in our lives right now, so please know that Ardent is always here for you. If you need to ask a question during the workshop, please click the Questions tab and type in your question. The photo to the left of the screen is of an iPad, and the photo to the right is the screen of a desktop. If you are viewing the workshop from a smartphone, you will need to swipe right to see the PowerPoint. We will be collecting questions you have throughout the workshop and will communicate them to Chris during the Q&A session at the end of the presentation. This workshop is also being recorded and will be available for you to view on Ardent's website. So now I will turn the presentation over to Steve Olson with Putnam.
Okay, good evening, everyone. I want to thank you very much for taking the opportunity to join us. My name is Steve Olson, and my official title is Senior Relationship Manager at Putnam Investments, and we have a terrific relationship with QSO Financial Services, and in particular, Ardent Credit Union. And on behalf of myself and my colleague who will be speaking this evening, Chris Gallipo, we really want to thank you for your time. We know it's a Tuesday evening. In many respects, a lot of folks have probably just had dinner, but we hope that you find this presentation value add. Before I turn it over to Chris, I just wanted to tell you a little bit about him. This year we've had some unprecedented times. There's no doubt. Chris has been a tenured colleague in the industry, and he and I have traveled extensively together. He's a senior investment director at Putnam, and he's going to communicate his thoughts on what we've seen in the marketplace going on right now. And there's a lot, let's face it, between obviously the global pandemic that we've all had to endure in late February, to the upcoming election and the divisiveness that we've seen in the countryside this year. But there's certainly a lot of noise out there, and we thought that it would be a really, really good time tonight to give you an update on what we're thinking about in the marketplace and the overall economy. Chris is a dear friend of mine. He's really humble. He's not going to say this, but he's a really good golfer, and he's got 2 beautiful dogs right now at his home, and we're all working at our home, especially all of us. We actually got a chance to share all of our pets this evening before we came on. I know that my dog Emmy's been my best friend by my side here since March, so my office here is in my kitchen. So with that being said, I'm looking forward to hearing an update. I know that even today we saw a little bit of volatility, and that's certainly not going to go away. But with that being said, I'd like to turn it over to Chris. And Chris, I want to thank you very much for your time this evening, and I look forward to hearing your update, sharing your active insights in this volatile marketplace. So take it away, Chris, and thank you.
Okay, Steve, thanks, and thanks for joining us, everybody. As Steve mentioned, the kitchen is the new office, and I have 2 brand new puppies here at my feet, so forgive me if they start to bark a little bit. It shouldn't be an issue, but you never know. I'm really just going to walk through and talk to you about the things that we monitor on a daily basis, things that we think are important to keep track of. And Steve's right. He said in his intro that there's a lot of noise, and there is, and there's more noise right now because we're in an election year. But I want to help you cut through all that and really just focus on what's important, and I can share with you what we're focusing on. I'm really going to just talk about 4 distinct areas. We're going to talk about the economy kind of from a high level, where we've come from and where we are and where we're likely to go. I'm going to talk about the stock market and the bond market briefly. And then we're going to talk about risks and opportunities as not only just right now and in the next month leading up to this election, but what we think is likely to happen in coming years. And as the slide says, we'll talk about all of that. So sit back, relax, and grab your favorite cocktail, and let's start just with a little high-level view of the economy. So what has happened here is not abnormal, first of all. We came into the year, the stock market, the economy in the United States rather, was beginning to expand and improve. And in the economies in Europe were basically, doing nothing. And the economies in Asia, China is the biggest one and the most important one, was continuing to slow down. And so before all of this started, our view was that the US economy was going to have the most durable expansion and be the strongest economy in the world. And as a result, that should produce the strongest earnings growth as well. Well, we still feel that way today. And the pandemic here is sidelined it a little bit, but we think we're going to resume and go back to the spot that we were in February before this started. And so as we sit here today, the US economy started to reaccelerate in the third quarter of the year, and the estimates for nominal GDP, which is the pace of economic growth, in the third quarter are up somewhere around 35% over the third quarter last year. And it's a big number because we're coming off a low base. It's our view, though, that the US economy will probably have the most durable recovery here, meaning that we think we have more levers to pull here, and we're willing to pull those levers, both on the monetary side and on the fiscal side. And that should help us both escape the recession and continue on a track that's stronger than economies anywhere else in the world. And I think the most common question that I've gotten from financial advisors here, probably from April right until this morning, is something like this. And the question is, can you explain to me how it's possible for the stock market to go up in the face of unrelenting bad economic news, right? The manufacturing sector basically shut down. The services sector has been shut down. Unemployment goes from 3% to 15%. How is it possible that the stock market can do this? And how do you explain the disconnect, right? The presumption there is that there's a disconnect between the stock market and the real economy. And so the first thing I would point out is that the stock market is not the real economy, and the real economy is not the stock market. They're two very different things. And so anytime we're talking about economic data, that is measuring a period that's already happened, right? And so by definition, that's backward looking. And for me and the rest of all the other professional investors, that is not helpful, right? I can't make decisions or use information for things that's already happened. My job is to look through the windshield as best I can. And so the economic data by definition is backward looking. The stock market is forward looking. And so the stock market is a discounting mechanism. It anticipates the future. And most of the time, the stock market is highly accurate. And it's certainly more accurate than the economists and the experts that they trot out and put on CNBC and other news stations. Disregard what they say, right? Most of the strategists and economists have never managed a dime in their life. And so their opinions, while eloquent, have never been tested under duress. Not saying that I'm always right, but I've certainly been tested under duress. And so the stock market normally begins to rally about 4 months before the end of every recession in the United States. I know that because I've done the research. So what's happened here is normal. This is not a disconnect. Actually, this is what happens. The stock market bottoms on bad news. It bottoms on bad news. And so that happened in March. And at that point in March, when the stock market is doing this, it's nerve-wracking. And the point of maximum fear when you as the client are talking to, you see the news on TV, the stock market in this case was down 35% in 3 weeks. That's scary, right? It cut into your savings and the money you had invested. That point of maximum fear, frankly, is also the point of maximum forward return. And we have to be very careful to guard against our behavioral finance. It's called behavioral, the study of people's emotions and investing is called behavioral finance. We have to guard against that. I have to guard against that too as a professional investor. I have to be very careful about that. And so the stock market has a cathartic sell-off in March and then begins to rally right when the news flow can't get any worse. That's normal. The stock market bottoms on bad news. The stock market does not bottom and ring the all clear sign when the news flow is good. By the time that comes, you've missed it. And that's why most people don't make money in the stock market, because they panic and they let their emotions drive their decisions. And almost always your emotions are wrong, especially at inflection points. And so the stock market bottomed on March 23rd and began to rally. April, May, June, and July, those 4 months, it's normal for the stock market to rally 4 months before the end of every recession in the United States. It's done it every single time, and it just did it again. So what the stock market's message to us is that the recession, while steep and severe, is also short-lived, right? Every recession generally is different. This is atypical in that this is the country was essentially shut down because of a virus, right? A medical condition. We haven't seen that since 1918, and I wasn't managing money in 1918. But human behavior never changes through all of that. And so you have a cathartic sell-off and then the stock market rallies. People say, why is it rallying? Well, that's what happens. It's how it works, right? So the stock market is telling us that the economy is on the path to recovery. The recession ended in July or August, and we're probably good from here. Now, what happens at the beginning of every bull market, and we are in the beginning innings of a new bull market, what happens at the beginning is everybody doubts it. Everybody doubts it. I can tell you right now that 95% of the advisors I talk to around the United States don't believe it still. That's the way bull markets start. And they end in euphoria when everybody thinks it's great, you're going to quit your job and be an investor, right? 1999 and 2000 is a very good example of that. So that's where we are. We expect the economy to continue to accelerate. The rate of change will slow down a little bit, but we expect nominal GDP in the 2021 to be somewhere around 5%. That is a big number. That is a huge number. And if we're right on that, then earnings, public company earnings, should be or have the chance to be better than we think, which is why the stock market has been so strong. One of the things that I think is interesting is this, that there's all different measures of sentiment, optimism and pessimism. It can be consumer sentiment, it can be business sentiment. One of the things that I noticed in August is that small business owners, right, which are at the epicenter of this crisis, are actually much more constructive than you would think relative to the headlines. And so there's a survey that's done every month that surveys the same 800 small businesses every month. And the question is simple. The question is, Chris, you're running your business. How do you feel about the state of business? Are you more positive than you were last month? Is your order book improving? Do you have inquiries coming in? Are you hiring people? And if the answer to those questions is yes, then the index begins to rise. And what I noticed in August was that index, again, it's done every month, was almost back to where it was in February before this whole thing started, which is remarkable considering that's the epicenter of the problem. Right? So small business owners who create a lot of jobs in the United States are reasonably optimistic on a go-forward basis. And that's pretty much in line with what the stock market is saying as well. So, for what it's worth, we'll continue to monitor that. But the question of how can the stock market move ahead when everything we see and hear and consume is negative, it's very normal. Do not get sucked into the noise, right? Don't get sucked into the noise and the negative drumbeat. And we're going to talk about the election in a little bit as well. I'll give you some points on that. So that's the backdrop. We think the US economy is going to recover. It is recovering. We think it's going to continue into 2021, 2022. It's not going to be a straight line. There's going to be volatility around that. And we think the US economy will have the strongest recovery in the world, which means the US stock market should be the strongest of any stock market in the world. That's a good segue for me to talk about the stock market and share our thoughts with you there. So we start the sell-off in February. Interestingly enough, we were cautious in February because of mostly because of valuation. I won't get into the weeds on that, but suffice it to say the stock market was very expensive relative to history in February. And no surprise, everybody was bullish, everybody was positive, Everybody thought it would continue. You never know when you could get a black swan. By definition, a black swan is something that comes out of left field that you could have never predicted. We didn't just have one, the virus, we had two. We also had an oil price war between Saudi Arabia and Russia that sent the oil market into a massive tailspin, right? So we had two black swans at the same time with a backdrop of high valuation. The backdrop of high valuation gives you zero margin for error, zero. And so the stock market was ready to correct. We get these two incidences and the stock market gets killed very quickly. Now, we go from a high valuation spot in February to a much more reasonable valuation spot by the middle part of March. The problem is everybody's too afraid to buy stocks in the middle part of March. You think you're going to lose all your money, right? Again, the point of maximum fear is also it coincides synonymous with the point of maximum forward return. So in March and April, we were busy repositioning the portfolio and making sure we owned the names that we wanted to own, right? Now what's happened? The stock market has rallied 60+% from the lows in March to the highs in September. The NASDAQ, which is where all the big tech stocks live, has rallied over 70%. The vast majority of investors miss that. And so now what happens? So now our best guess is with 30 days before the election, the stock market probably does this and probably stays in a range like this. So I wouldn't expect much in the way of progress from here until we get into this election and through it. But something interesting happens as the economy begins to emerge from recession. Here's what happens. There's a basket of stocks that have done very well here this year and have done very well over the last, let's say, 10 years. Those are the big growth stocks, the big tech stocks, right? We all know these names: Apple, Amazon, Google, Facebook, etc. And that is explained very easily because in a slow growth environment, which is basically what we've had for the last 10 years, companies that can grow their revenues and grow their earnings get rewarded by the market participants. And so we've seen all that. Now, what happens normally as you emerge from recession is as the economy begins to lift, the earnings tide begins to lift as well, right? And companies that are more sensitive to the economy, so if Apple is over here, which is semi-impervious to the economy, and Cat Tractor is over here, which is very dependent on the economy, what we're likely to see from this point is Apple's earnings continue to do this, while Caterpillar's earnings do this. And so companies whose businesses are GDP sensitive are likely to do better on a go-forward basis as the economy recovers and reaccelerates. And so what does that mean? So what that means is cyclically oriented names and quote unquote value stocks are probably about to have their day in the sun. And I've conducted a lot of research around that. And what we've learned is that from the trough of the recession, which is probably August, so just a few months in the rearview mirror here, value stocks outperform for the next 5 years. And so people will often ask, well, where's the puck going? Well, that's one place where the puck is going. And so I think the big growth names like Apple and Amazon and others, and I love those stocks. I've spent 30 years as a professional investor, all of it as a growth manager. So I know those names very well. They're wonderful companies. The stocks probably take a pause here and other parts of the market start to respond. Think financials, think retail, think railroads, think heavy equipment and industrial names. Think anything that's dependent on consumer spending. Nike's a great example of that. They reported earnings last week or the week before. The earnings were 100% better than Wall Street anticipated. 100%. That's pent-up demand, right? The economy is much stronger than people think. And once we get a vaccine, which we will get, and we get back to normal, which we will do, then I think the economy probably explodes in 2021. The other thing that happens as you pass the bottom point of a recession, so we're probably right here right now and about to get up on this upstroke, is smaller companies that have been left in the ditch on the side of the road start to participate. Well, why is that? Well, we know that in a recession, me as a stock picker will want to make sure that the stocks I own, Apple, are going to make it through to the other side of the recession, right? Meaning they have revenue growth, they have a lot of cash on their balance sheet, they have de minimis debt, they have strong free cash flow generation, so they have a lot of financial statement flexibility. Well, a lot of smaller companies don't have that. They have the inverse of that or the reverse of that. They might have de minimis earnings power. They might be severely impacted by a recession. And that's true because most small companies are domestically focused, right? Their business is here in the United States. It's not overseas, it's right here. And they probably have a lot of debt on their balance sheet. So investors will bypass those companies and buy the quote unquote safer plays or the growth stocks before the smaller names. Well, from the inflection point of a recession going forward for 3 years, guess what happens? Small company stocks start to outperform large company stocks. That's already started to happen. So the puck is going toward value and the puck is going towards small cap. That's what history says, and that's probably what's going to happen again. It's actually already started. So I think to your near-term expectations for the equity market should be more chop into the election. And then once we get on the other side of that, what really matters is not the election. It's not tax rates. It's not the threat of higher tax rates. What really matters is economic growth and earnings growth. That's what drives the stock market. Everything else is noise. Everything else is noise, and it's a distraction, right? All right, on to the bond market. So I think this is a real challenge because we know that the central bank has put short-term interest rates basically to zero, and long-term interest rates, mortgage rates, and 10-year bond rates are as low as they've ever been. And so what are they trying to do there? They're trying to say that the cost of money is free. Go buy a house, go start a business, right? Take risk now while the cost of capital is low. And so that's why the Federal Reserve is very powerful and they're controlling short-term interest rates. That's unlikely to change, not for quarters, but for years. So expect rates to stay lower for longer. Now, this is good for the economy. It's, it encourages risk-taking and it's a stimulative stance, but it penalizes investors and savers, right? Because your financial advisors have you exposed to the stock market. They also have you exposed to the bond market. I'm assuming, right? And the exposure to the bond market serves two purposes. Number one, it's a source of diversification away from equities, right? So when equities correct, like they did in March, quickly, you probably made money in bonds. You definitely made money in bonds, in treasury bonds, right? So diversity is one issue. Income is another. Fixed income carries, coupons and yields, right? So it helps generate income. So it's both a ballast, a diversifier, and an income generator. Well, today, because rates are so low across the curve, it might be a little bit of a diversifier, but it sure as heck is not an income generator. And so this is a real challenge. And frankly, there's no real easy answer to this. You can try and buy stocks that have high dividend yields. You can try and buy preferred stocks. You can buy convertible bonds. And all you're really doing there is taking more equity risk with a little bit of a backstop. But that's very different than owning a bond, right? The other issue that we have here is that because 10-year bond yields are so low, and we think they're going higher. So if you were a buyer of 10-year bond yields today, number one, you're assuming with the yield of 0.7 or 0.8 and inflation at 1.7, your real return is negative. You're guaranteeing yourself you're going to lose money if you're a long-term investor on a real basis, on an inflation-adjusted basis. Why would you do that, right? And so it's a real conundrum here. It's a real conundrum. And our advice to advisors around the country is wait for interest rates to back up. We think they're probably going to go up north of 1 toward 1 and 1.5%, which when you think about it, it's in my 30-year career is still incredibly low. There are people on this call I know who remember mortgage rates at 17, 18%, and you could get 15%, annual yield on a CD. Wouldn't that be nice, right? Those days are gone and they're probably never coming back. So this is a challenge. Now, the Fed will keep rates low until the economy has recovered, not for a couple quarters, but if you listen to Powell, he's talking about a couple years. So we're going to have to probably have to lower our expectations for fixed income returns for the next couple years. The good news is that is bullish for risk assets like the stock market, right? And that's one reason the stock market has also been strong. The Fed is reliant upon a backdrop of low inflation, and we have that, and we have had that for 10 years, and it's likely to continue. And a common question I get from advisors and investors is, Chris, how is it possible that we're not going to have a big spike in inflation with all this stimulus and all this money printing? Well, there are more than two reasons, but I'll give you the two big reasons. And number one, we're never going to have employment when the unemployment rate is 10% or approximately, right? It's not going to happen. And we're never going to have inflation when the savings rate is north of 15% and almost at 20%. So while there's a lot of money sloshing around, the velocity of money is still way down. So until that changes, inflation is likely to remain subdued. In fact, if you look at the bond market's measure of inflation 10 years from today, it's 1.70. So the markets are saying inflation's not only is not a problem now, we don't think it's going to be a problem 10 years out. Think about that, right? It's amazing. And actually, if you look over history, over a 100-year period at the CPI data, which is the Consumer Price Index, and it's the most recognizable measure of inflation, you know what the reality is? Inflation never really occurs. It occurs only in when and if there are major spikes in the price of oil. That's not going to happen anytime soon, right? And the oil supply demand dynamics have changed significantly from the 70s, 74, 75, from 80, even from 2006 and 7 when oil went to 150 bucks. Landscape's different now. US is a net exporter and the big marginal producer. So, and there's a lot of supply demand issues there. So in fixed income land, it's difficult. I would lower your expectations for returns, and I'd be very thoughtful about the use of US 10-year bonds that normally serve as a yield component and a diversifier. Probably unlikely to do that on a go-forward basis. All right, I'm almost done. Let's talk about near-term risks and opportunities, and we'll hit the election. All right, I think it's likely as we go to the election, volatility remains high. That means you have big up days like yesterday and big down days like today. Who knows who's going to, what could drive that? But it will continue. A classic case today with Trump saying that he wants to shelve the stimulus talks till after the election. Market was up, closed it down 2%. Get used to that here in the next 30 days. And possibly after, if the election is contested, and it sure seems like they're going to contest it if it's close, right? That near-term volatility creates near-term opportunity as well. Don't forget that stock prices going down actually is a good thing for long-term investors. Why? Because stocks go up over time. Average annualized return, 9.8%. And when stocks go down, your forward rate of return goes up, not down. It goes up. Don't lose sight of that. So any significant sell-off, we will use at Putnam as an opportunity to put money to work in equities and in corporate credit, meaning the corporate bond market. And if interest rates back up, they probably wouldn't under that scenario. But if they did, we'd be buyers there too. Final thoughts on the election. For the advisors on the phone, I wrote a research piece here a month and a half ago or so. It is approved for client use. I'm going to hit the 3 most important takeaways from that research, but you can both A, read it, and B, disseminate that to your client base if you think it's valuable. Interesting data point number 1. In the 3-month window, August 3rd to November 3rd, in that window leading up to the election, if the stock market is up, the incumbent has won 85% of the time. This is going back 100 years now. 85% of the time. Right now, the S&P is up about 3% in that window. So we've got a couple weeks left, and October is a notoriously volatile month, so we'll see. Interesting data point number 2. In the election year, if there's been a recession, check, we had that. If there's also, or a bear market, a 20% correction in equities, well, we had that too, so we had both. If one of those occur, never mind both of those occur, the incumbent has never won. That's happened 6 times in US history. The incumbent has lost every single time. So, I'm not sure how this is going to play out, obviously, but that leads me to number 3, which is the single most common question from financial advisors all over the United States. And it's coming from, according to them anyway, it's coming from their clients. And their clients are telling the advisors, hey, if Biden wins, I want out. Sell it all. He's going to raise taxes. That's going to slow the economy, so on and so forth. I'm going to lose all my money. Sell it all. Ready for reality? In the last 100 years, equity returns under a Democratic president are 100% better than equity returns under a Republican president. 8% to 4%. That's the empirical data. That's not my opinion. That's the reality. Further, I just published another paper on marginal tax rates, capital gains tax rates, effective tax rates on the personal side and on the corporate side, because most clients seem to be worried about the fact that taxes are going to go up. You know what's interesting? There is zero relationship between the top marginal tax rate, any marginal tax bracket, the capital gains rate, the effective tax rate for people, the effective tax rate for corporations. Zero correlation between tax rates and equity returns. It doesn't explain anything. It's irrelevant. It's immaterial. It's immaterial to stock returns. right? There are other variables that are much more important. Number one, the growth of earnings over time. That's what drives stock prices. And then economic growth would probably be number two, but it is not tax rates. So don't worry about that. Don't worry about that. I can tell you with 100% certainty that we run $180 billion. We are not worried about the election at all. Doesn't matter if Trump wins, doesn't matter if Biden wins. We will make no significant changes in our portfolio. Any portfolios, an equity portfolio, a fixed income portfolio, a multi-asset class portfolio, no changes. So I hope that puts your mind at ease a little bit. And again, you can read that research for yourself. But I'm done with the prepared comments, so we'll hit the pause button here, and I'm happy to take any questions from anybody in the audience.
Hi, Chris. Yes, we do have some questions, but before we do answer them, I would just like to remind everyone that on the PowerPoint, you can see how you can ask a question through our chat box. So our first question is, why is there a coin shortage?
I'm a stock picker. I have no idea. But I see that when I get coffees in the morning, and I thought to myself, what is going on here? You know, my guess would be everyone's using debit cards, but I'm not sure. And that's not really something I ever spend much time thinking about.
All right. Our next question is, what top value stock should people be buying?
I'd love to give you the answer to that. My compliance department doesn't want me to do that. So when you think about quote unquote value stocks, there are two different types, right? There are stocks that are quote unquote cheap by a lot of different measures, and that are good.
I believe Chris's computer has froze, so if you just give us a couple of seconds, we will get him back up and running.
I appreciate that. You know something? This is Steve here. Mine actually froze as well. Interesting. I will let him know if you guys could just stand by.
Not sure if I lost you guys, but almost seems like the audio cut out on my end.
I think we're okay
You're good,
now,
Chris.
Okay.
Yeah, we're good. Thank you.
Yep.
All right, so I guess we'll move forward with our questions, Chris. So one of our guests in the audience asked, do you foresee an exodus from urban lifestyles to the suburbs? And if so, how will that affect the cities?
Okay. Well, I think we already see that a little bit. So I live about 60 miles north of Boston. I actually live in New Hampshire on the seacoast. And I can tell you that the real estate market here is as strong as I've ever seen it. And, you know, I think about a city like Boston where, you know, when I got out of college 30 years ago and started to work in town, the development really has been nonstop. And so you have a couple things there. You have super high priced residential real estate to be close to, you know, where the jobs are. And you have super high priced commercial real estate. I'm not sure about the residential stuff necessarily. I think the prices will come down. I think commercial real estate potentially is the biggest risk, because what we've learned, really, if you just take Putnam alone, and I'm sure other people have experienced this, we have 2,300 employees. We run $180 billion. We've been doing it from our kitchen since March. And you know what? It's seamless. We really don't need all that office space. And so we're not the only company thinking like that, I'm sure. Others are probably thinking the same thing. So my guess would be that suburban real estate prices are firm, and they've been firm, and the supply is low, and prices are going up.
All right. Our next question is, what will be the impact on oil prices in companies as demand has decreased?
Well, we've already seen it. Oil stocks have been the biggest laggard in the market year to date. The energy sector now comprises about 2.5% of the S&P. But that's very different than, let's say, 2008, when it was 12 or 15% of the S&P. And so whatever happens to oil stocks now, energy stocks now, Exxon, Chevron, et cetera, is immaterial, won't have any impact on the S&P. Now, this is probably a good example of very well-run companies, especially Chevron. That's not a recommendation to buy the stock. Please don't do that. But Chevron and Exxon are world-class companies. Will they make it through this? Yes. Right. So at some point, the supply-demand balance will shake out and become, more in line. In which case, the underlying commodity will start to rise. But we're probably a long way from that. Exxon is a classic case of a company that's got a 10% dividend yield, and you have to wonder about the sustainability of that yield, i.e. if you buy it thinking you're going to grab the 10% yield and there's no risk that they're going to cut the dividend, you're probably mistaken, right? So be careful with that. But, there's a lot going on that affects energy prices, not just in the United States. It's massive oversupply, de minimis demand. The demand side will come back as the economies reaccelerate. There's a lot of bad news priced into those stocks, but you also need some sort of catalyst to have the stock prices go up, right? Just because they're cheap doesn't mean they can't stay cheap.
All right. Our next question is, where are the opportunities in this market going forward, or is it too late?
Well, I gave you two. I think that the puck is going toward more cyclically oriented names, quote unquote value names, industrial companies, material companies, banks, right, that are very front-end loaded and sensitive to the economy. Those stocks are all, for the most part, are down and depressed, and they'll have their day in the sun again. History says it's a 5-year wave, so we haven't even really started yet. That's one place. Small cap names, same thing. Been left by the wayside. They'll start to recover as the economy reaccelerates. I would not, as a 30-year, I don't have all the answers, folks, but as a 30-year stock picker and as a growth manager, I'd be very careful about chasing the big tech stocks here. They're great companies. They're great companies, but stocks do not go straight up ad infinitum. And that's exactly what's happened. The time to buy those names was March, April, and May, not in October.
All right. Next, our next question is, where do you see the unemployment rate by the end of the year?
By the end of the year, probably not much change. By 2023, 2022, back down to 5%. That's our best guess.
All right. And we have time for one more question. This question, our guest read an article several weeks ago which highlighted the concerns surrounding stagflation. What are your thoughts? Don't
worry about it. That's the least of our concerns. Stagflation is high inflation and no economic growth. Not likely. We're likely to have the reverse of that. Above trend economic growth and below trend inflation, which is a Goldilocks scenario for risk assets. Exxon just came across the tape with an announcement, and as I was answering that question, I missed what they said, but Exxon's on the tape right now with news.
All right, and that was our last question for tonight, so thank you, Chris, for providing us with some great information.
No problem. Thanks for having me.
All right, and we appreciate everyone logging in and joining us for our virtual workshop tonight. Please feel free to contact one of our financial advisors, Andrew, Jim, or John, to schedule a one-on-one meeting or call with them. And once again, we would like to thank everyone for attending. There will be a short survey sent out via email, and we would love to hear your feedback to help us improve for future workshops. Thank you again, and have a great night.
Thank you very much. Thanks, Chris.
Sure, thanks, Steve.